A recent study showed that for an average American worker who takes Social Security, it only replaces about 37% of their income. And for folks that have above average earnings, it only replaces usually 25 to 30% of their income. With that in mind, we've got to be saving towards a 401k to be able to make up that lost income because most Americans don't have pensions these days. So we'll be talking today about how to allocate your 401k, how to think through the steps and the process that you could use to do so.
So Spencer, no two investors are alike. No two financial plans are the same. So really when we think about allocating a 401k, we have to come back to what are the goals, what are the time horizons, what are the resources that people are being able to put in. And so as we think about this, if you've missed any of the videos that we've done about creating a financial plan or setting goals, or even what are 401ks or different investment accounts that you can use, you can go back and watch any of our other videos about that. Today, we're just going to focus though on how do you actually allocate a 401k. And we would say this is other traditional IRA resources, things that you are saving into during your working years in preparation for retirement.
Right. And it could be a 403B for our nonprofit friends. It could be a 401A or 457 for some of our university professors and other folks that have different kinds of retirement accounts. But it's the retirement account that we're really talking about.
Yep. Yeah, that's right. So we've got 5 areas of consideration for what we're going to talk about today. But before we go into any of those, consideration number 0, get the free money.
Get the free money.
Why is this so important?
Well, there's no place in the world that you can get 100% rate of return from day one other than getting that employer match. So it would be a very, very, very rare circumstance that we wouldn't suggest someone go ahead and put in the money to get the free match. That's where we always start and encourage clients is to contribute enough that you're going to get that full match from your employer and at a minimum go that direction.
Yep. Okay, so now let's move on to the actual 5 areas of consideration. Sure. So first, we come back to investment goals. So when you think about your financial goals, you got to think about where do you need to invest money. Mm-hmm. So talk us through why having these investment goals is really important when we're thinking about our 401k and allocating those retirement plans.
Right. So as we think about it, what we want to make sure is that we've got a sequence of the actions that we want to take in light of the goals that we have. If we have no primary reserve account, still we want to get the free money, so we want to do that match. But after that, instead of investing more in our 401k, our first objective needs to be build that primary reserve up to 3 to 6 months of living expenses. So that is one of those things that would come before any further investment above and beyond that employer match that we would get. We also need to know if, say, we want to buy a home and we need to be saving for a down payment there. We don't want to be investing in the 401k above and beyond the employer match if we're planning for purchase in the next 6 months and we don't have enough to do that down payment. So we need that clarity of the goals that we have so that we can say, well, this is the amount that I need to be saving into the 401k along the way to achieve these goals. Another example would be maybe we have young children and we have a goal to be able to save for their education. It could be a set of circumstances where we don't need to save anymore to the 401k because we've saved all that we need to and there's other goals or considerations that we have. So the first step there is let's make sure that we have our life plan in order and those key goals so that as we put together our financial goals in our financial plan, that they can align well with that.
Right. Because we have to also remember, once you put those assets in the 401k, they're locked.
Right.
Now, you can get them out, but it typically is because of death or disability or some major life event. And so really you don't want to count on those to be available resources. So that's why we're saying, hey, it's really important to think about these goals because once that money's in your 401k, it's locked until 59 and a half, or you're going to pay a penalty on it.
Or in some circumstances, there are plans, of course, that have loans that are available. That's not a direction that we would suggest clients going most of the time, and certainly not to plan to go in that direction. It is possible in some circumstances up to a limited amount typically. Typically, a loan is going to be capped at something like $50,000 for most plans, if it's available at all. Right. So we have to be very, very careful about thinking, about touching those resources before age 59 and a half for sure.
Yeah. So that kind of dovetails into this next idea, is that really you have to think about, what is your time horizon? If I'm a 25-year-old just starting off my career, it's going to be very different than if I'm 65 and getting ready to retire. So talk us through a little bit about that time horizon and how that affects this investment goal.
Well, for most of our clients that are in their early career time frame, or even mid-career, we look at it and say, if we've got several decades before retirement, it would be an unusual set of circumstances if we look back historically, for sure, if stocks didn't outperform bonds over 20 or more years. Certainly could happen going forward, but if we look at that long-term trajectory, oftentimes our younger clients, just sheerly because they have a longer amount of time going forward, they have space for the stock market to go up and down many, many times before they retire and need to use those resources. So they may have a higher risk tolerance if they can just not look at the statements and freak out. If they can instead just say, this is part of the course, I'm investing for a very, very long time horizon, it gives them maybe more of a capacity to invest aggressively than, say, a client who's within a couple of years of retirement and really wants to start to utilize those resources through withdrawals.
Right. So that kind of plays into, as you've talked about stocks and bonds and that mixture therein, we talk about risk tolerance, and this is the second consideration. So when we think about risk tolerance, you were talking about, okay, how long does a client have before that life event that they are retiring and they need to use the resources? What are some other things that we can think about and we need to consider when we think about risk tolerance?
Well, it's really, we don't want to make a bad decision at the wrong time. So if we have the stock market dropping substantially, let's think, back to 2020, the stock market dropped by almost a third in a month. We don't want at that time to get the jitters and sell from stocks at an inopportune time when they've just taken a beating. We also wouldn't want to do that in the midst of the global financial crisis or some of the other corrections that we've seen here over time when the stock market is down. And, the stock market, it's often been said that the stock market is the only market in the world that when things go on sale, people run for the exits. They run away from these deals. And that's really what's happening. We're buying companies and we're buying them on sale when stocks go down. We don't want to be in a position where we have to sell stocks in that environment. So as we think about our risk tolerance, we need to make sure that we've got this idea that when the statement comes and our accounts are down, we are not selling stocks. We're not selling those volatile assets. We want to have a risk. We want to know ourselves well enough and understand our risk tolerance well enough where when those investments go down, we're able to stay the course and maybe even be a little more aggressive, in the midst of a downturn, but at least stay the course and not sell those more volatile assets in the midst of that. The other thing we always want to distinguish between risk capacity and risk tolerance, because risk tolerance is more innately wired in us. Our risk tolerance, if we get a statement and we just can't see that go down, then we've got a clue that maybe we need to make sure that our investments are not all that volatile. Now, our risk capacity, we might be at a point where, we might be moving towards retirement and we know from our financial plan that we have our expenses covered by Social Security and by pension. We might not need these funds. So from a capacity standpoint, we could be very aggressive with them. But from a tolerance standpoint, our innate wiring says, you're not there. You're not there. You need to be more conservative in here. So as we look at that, we want to grapple with both of those features, both of those considerations, the risk tolerance and the risk capacity as we make decisions about how to allocate the portfolio.
Yeah. So that really takes us into this next piece, and it's diversification. So I shouldn't put all of my investments into leveraged Bitcoin. Is that right?
Yeah.
Or any cryptocurrency? Should I put everything that I have there?
No, we come back and we want to be well diversified. So diversification is our friend there. If we look at any study that's out there, it would suggest that as investors, of course, we want to be those that get the best return, the best likely return for the amount of risk or the amount of volatility that we're taking on. There's not that many free lunches that are out there in economics, but one of them is diversification. So by diversifying, by owning more stocks, our risk-adjusted return, that is the risk relative to, or the return relative to the risk that we take on, is going to be better if we diversify at least some. You know, that one stock that you think can't miss, that's not the only one that we want to be owning, just because if it does miss, we're in trouble.
Right. Well, and we laugh about leveraged Bitcoin and cryptocurrencies, but this could be said if you have all of your resources in your company's stock. Yes. That is not diverse. Yeah. You may believe the world about your company, but it's not diversification. Right. And so really, if you have a significant holding from stock options, we really need to take those 401k assets and say, okay, yeah, you may be in a tech sector that you believe is going to go really well. Okay, but let's diversify and make sure that the rest of our holdings aren't all concentrated in this one sector.
Well, and you make two good points there. One is that particularly if we have company stock options or we have company stock in our 401k, we want to be very careful about the amount that we invest there. We don't want to go typically beyond 10 to 15% in a portfolio, or we could say if we go beyond that, we have to be ready to surrender or lose those funds. So, you know, if you didn't need the funds and you had $1 million in your 401ks, your company through your 401k, and you didn't need that for your financial plan, okay, you know. But if you need those funds, then what we want to do is make sure that they're put together they're invested in a way that makes sense from a best practices standpoint to be able to diversify some. The other key thing I think there that as we look at diversification is we don't want to just chase the hot sector or companies or even mutual fund of the last year, 3, 5 years. What we want to look at as we look at diversification is, am I investing across a wide swath of sectors, geographies, different types of companies, the difference between, of course, equity investment, fixed income, real estate, other kinds of investments there, and make sure that our plan aligns such that our investments align with our goals there overall. Because I can't tell you the number of folks that we sit down with the first time and they are invested in the particular funds within their 401k that did well over the last 1 or 3, 5 years. And we say, well, when did you go all towards that fund? Oh, a couple months ago. So they didn't capture the returns that were so good. And maybe it was technology that they didn't capture that was so good. But that asset class has had its day in the sun. And they're not diversified now. They're just chasing what did well in the rear view.
Right. Okay, so kind of correlated to that is our next consideration, and it's fees and expenses. And some of those funds that have done well historically, some of the more actively traded funds or actively managed funds, can come with higher fees and expenses. And sometimes they don't have that same long run trajectory where, yeah, you said they may have had their day in the sun. So if you're paying a higher fee and their returns may not be lower because they can't manage it and continue to get that same return, how are fees and expenses, how do they play into this?
Well, we want to be very attuned to what the fees and expenses are in any kind of retirement plan. We want to make sure that if a client is putting resources into the plan first, because there are plan expenses that are out there. Now, some companies will pay for those plan expenses, and that's wonderful because then the employees' funds don't have that headwind. But others, it can be a very significant expense. It can even be 1% or more. So we want to be careful as we look at that. The larger companies tend to do a better job of getting a better deal on their retirement plans and even paying some for those as an employee benefit. But we want to be careful with that first. The second thing is, as you alluded to, the funds within the 401k, they have various expenses. And so what we tend to like is funds that have low expenses and really, really broad diversification. And oftentimes that is best done in either an index fund or a target date fund that uses index funds. And the reason that we would tend to kind of lean in that direction is simply because the actively managed funds, oftentimes they'll be replaced from time to time because they'll have better performance or worse performance, and we don't really know what's going to happen with that replacement. There's a whole lot of review that would need to take place that a client would need to be able to assess what's going on with that new fund or why the old fund didn't perform as well. But if we look at the overall landscape of mutual funds, something like 8 out of 10 of them on an annual basis on average are not going to keep up with their benchmark. And they're not going to even come close to keeping up with their benchmark. So we will typically look at things and say, okay, if we can get close to that index return, that's going to be kind of trying to hit singles and doubles rather than swing for the fences and get some kind of fantastic rate of return relative to an asset class through active management.
Right. And even those that do outperform in a 1-year time frame, it's historically shown that they don't continue their outperformance over a long period of time.
Yeah, on average, for sure. When we look at studies that have been done that would isolate, as you said, those outperformers, most of the time going forward, they're going to struggle to maintain that same level of outperformance for a variety of different reasons.
Yeah. Okay, so that kind of hits this last one, our last consideration, and it's rebalance periodically. Mm-hmm. So when we think about rebalancing, thankfully you alluded to the target date funds. Mm-hmm. Those are ones that automatically rebalance for you. Mm-hmm. Let's say you're wanting to have a little bit more say in your 401k allocation. What do we need to consider when we think about rebalancing?
Well, we want to do so on a cadence that we control and we actually implement. Mm-hmm. It's one thing to say, well, I want to rebalance quarterly or annually or some other cadence. It's another thing to actually do it, to put it on the calendar to say, okay, I'm going to come in and rebalance. Now, there's more and more 401k offerings that are out there that will help you in that rebalancing so that it's really not a big time investment. For some plans, it's a very low time investment, but it typically is still a time investment to go and rebalance that. For other plans, it can be more onerous just because the technology isn't there or there's just challenges with respect to that rebalancing. A target date fund, of course, it's doing that automatically, and it's typically getting you more and more conservative with each quarter or each year moving forward. It's kind of that set it and forget it type of option if you like the idea that you're going to get a little bit more conservative every year going forward. That can be a good option for some folks that say, I really don't want to have to touch this on a quarter-to-quarter or even year-to-year basis. I want to just know that I'm getting a little bit more conservative over time. Now, for other folks, that's not a great option. And so this is not at all one size fits all, because for some folks, they really don't want to be getting more conservative over time, and their financial plan is such that they shouldn't be getting more conservative over time. Yeah. They want to rebalance to have that set stock and bond percentage there. So it's certainly not a blanket recommendation for target date funds, but just an acknowledgement that because target date funds are rebalancing automatically, for a lot of folks, it can kind of take the emotions out of this whole process, and it can allow them to just make sure that the funds are going in there, that there's salary reduction that's being done from their paycheck. They go into the 401k or 403b, and they're invested according to the plan. And that can be quite a helpful thing, because study after study would suggest that as investors, the one thing that we're really good at is shooting ourselves in the foot. It is selling stocks when they're down, buying stocks when they're high. It is selling bonds when they're low, buying bonds when they're high. So one of the things, either rebalancing over a cadence that we actually implement or using a target date fund, can help to offset that psychological tendency that we have by and large.
Yeah. So now let's talk about a couple of things you should avoid.
Yeah.
So one of them is neglecting your 401k.
Right.
This seems obvious, but why should we not neglect our 401k?
Well, you wouldn't, it's amazing to us the number of folks that actually forget that they have a 401k at a former employer. So they might have a smaller account. Let's just say they've got, $1 million at one employer, and they had this, job for a couple of years at another employer, and now they have an account that's $30,000 or $40,000 that they've just kind of forgotten about, or they have a mental placeholder, but they never keep up with the statements, and maybe the funds have changed and the administrators changed many times. So we don't want to neglect, in that way. We also don't want to neglect because at least we want to update the financial plan in such a way that we reaffirm that, yes, this target date fund or this mix of stocks and bonds is the right one, at least over time, every couple of years.
Okay, next one. Avoid emotional investing. You kind of already talked about this. Investors are really good at shooting themselves in the foot.
Yeah.
How do we avoid emotional investing?
Well, first we have that plan, And then second, we come back to it and we just implement. There are different ways that we can avoid this. As I mentioned, a target date fund can be helpful for some folks, just rebalancing. But it really comes back to having our eyes on the horizon of those long-term goals and then just adhering to it. I think some of it too, it comes back to we've got to look ourselves in the mirror and say, can I take on this level of risk and sleep at night? If we can't, then we need to downgrade the ups and downs in the portfolio by moving to a more conservative posture, but we also need to keep this in mind and not go back to the more aggressive posture just because the stock market does better, the next year. We need to be able to have that self-assessment that becomes a bit more conservative maybe and just deals with the ramifications of that, because again, we don't want to be tempted to sell when stocks are down at any point.
Yeah. This last one we've talked about earlier, but it's avoid over concentration. So if you've got that employer stock, or if you're really thinking the tech sector is going to go bananas, like avoid that over concentration. Diversification, it's shown historically to really mitigate some of that risk. But anything else you want to touch on with over
concentration? I think one of the other keys here is we don't want to put too much stock in what the rate of return has been with the funds in the portfolio, because it's really tempting to look and say, okay, well, this fund did the best over the last 3 years or 5 years or 10 years. I'm going to overweight here. That's oftentimes the exact opposite direction that we want to go. Or this fund did remarkably well, over the last 10 years versus its benchmark. Well, is there a different fund manager? Did the fund have $1 million then and now it's got $10 billion to manage? There's all kinds of different differences, that we have to pay attention to there if we're going to make good decisions. And we basically need to go back to the plan rather than look at maybe the performance of one fund versus another and pick that and concentrate our portfolio on the winner there. We hope that you've enjoyed this video. As always, every investor is different. Take this with a grain of salt. Use your financial plan, talk with your financial advisor to craft a strategy that makes sense in your situation. With that, if you have any questions, don't hesitate to reach out to us, and we'll see you next time.
If you like these financial planning videos, please share with a friend, and if you have questions, go to our website at SiriusRetirement.com. This content was provided by Retirement Planning Services. We are located in Knoxville, Tennessee. You can visit our website at SiriusRetirement.com. The information in this recording is intended for general educational and informational purposes only and should not be construed as investment advisory, financial planning, legal, tax, or other professional advice based on your specific situation. Please consult with your professional advisor before taking any action based on its contents. Advisory services offered through Retirement Planning Services, LLC.